In 2004, a single corporation controlled a staggering 60% of the home video rental market, generating nearly $6 billion in annual revenue through a global network of 9,000 physical storefronts. This dominant company appeared invincible, yet within 6 years it would file for bankruptcy protection, its empire reduced to a cautionary tale of corporate obsolescence. The prevailing narrative suggests this giant simply forgot to innovate, stubbornly refusing to acknowledge the digital future. But investigating the true architecture of this downfall reveals a far more intricate and devastating reality. The systemic reasons behind Blockbuster's collapse had very little to do with a lack of vision, and everything to do with a financial infrastructure that actively punished adaptation. To understand this systemic failure, one must first dissect the fundamental economics of the traditional video rental model. The core product was never the film itself, but rather the logistical convenience of immediate, localized access. The storefronts operated as decentralized distribution hubs, requiring massive capital expenditures in real estate, localized inventory, and hourly labor. This physical footprint created a formidable barrier to entry for local competitors, establishing a localized monopoly in thousands of neighborhoods. However, this same infrastructure demanded an unrelenting stream of foot traffic to justify its immense fixed costs. The most critical and ultimately fatal component of this revenue structure was the reliance on punitive pricing models, specifically the implementation of late fees. By 2000, these penalties accounted for nearly $800 million in pure profit, representing roughly 16% of the corporation's total revenue. This created a profound moral hazard within the corporate ecosystem. The business model was structurally dependent on the consumer's failure to return the product on time. Management was financially incentivized to maintain friction in the customer experience, directly aligning the company's profitability with consumer frustration. This perverse incentive matrix paralyzed internal innovation. Any proposed strategy that improved customer convenience by extending rental periods or eliminating penalties threatened to instantly vaporize hundreds of millions of dollars in high-margin revenue. Executives were trapped in a classic innovator's dilemma, beholden to quarterly earnings reports that demanded the preservation of this lucrative, yet adversarial, revenue stream. To abandon the penalty model meant accepting a massive, immediate financial contraction, a move that public market shareholders would fiercely punish. It was precisely this structural vulnerability that a nascent startup named Netflix targeted in 1997. The new entrant did not initially leverage revolutionary digital technology, but rather exploited a logistical arbitrage opportunity through the United States Postal Service. By pioneering the DVD-by-mail subscription model, they completely bypassed the massive overhead of physical retail storefronts. More importantly, they eradicated the penalty-based revenue model entirely. For a flat monthly fee, consumers could keep a disc indefinitely, effectively weaponizing Blockbuster's own profit engine against them. The legendary encounter between the two entities in the year 2000 is often framed as a colossal misjudgment, where the startup offered itself for acquisition at a mere $50 million. The established giant declined, a decision widely mocked in retrospect. Yet, viewed through the lens of strict financial mechanics, the rejection was entirely rational for a legacy retailer. Acquiring a cash-burning startup that fundamentally cannibalized the highly profitable physical store network contradicted every metric of traditional corporate valuation. The legacy infrastructure demanded protection, blinding the executive board to the existential threat quietly gathering momentum. Compounding this strategic paralysis was a complex web of franchise agreements. A significant percentage of the 9,000 retail locations were not corporately owned, but operated by independent franchisees who had invested heavily in the physical rental paradigm. Any corporate pivot toward centralized mail delivery directly threatened the livelihood of these franchise owners. This internal political friction created a powerful lobbying force within the organization, actively resisting any operational shift that diverted revenue away from the local storefronts and into a centralized corporate distribution network. As broadband internet penetration expanded throughout the early 2000s, the underlying economics of media distribution began a seismic transformation. The physical disc, once the absolute standard of home entertainment, was slowly being recognized as a temporary bridge technology. The true battleground was shifting toward data transmission. Yet, the legacy retailer remained tethered to its physical inventory, unable to untangle itself from the billions invested in tangible assets. The infrastructure that had established their dominance was rapidly becoming an inescapable gravity well. In a belated attempt to counter the postal insurgency, the legacy giant launched its own hybrid initiative known as Blockbuster Total Access. This program allowed subscribers to rent discs online and exchange them in physical stores, effectively merging the digital interface with the retail network. Initially, this strategy proved remarkably effective at acquiring subscribers, leveraging the one asset the mail-based competitor lacked. The physical proximity of the stores provided immediate gratification, briefly stalling the startup's momentum and proving that the incumbent could execute a complex logistical pivot. However, the financial architecture of this hybrid model was inherently self-destructive. Every time a customer exchanged a mailed disc at a physical location, the company absorbed the cost of the initial postage, the logistical expense of processing the return, and the lost potential revenue of the in-store inventory. The initiative was bleeding capital at an unsustainable rate, sacrificing hundreds of millions in short-term profitability to capture market share. This aggressive cash burn immediately triggered alarm bells across Wall Street, fundamentally threatening the corporation's valuation. The catastrophic drain on capital attracted the attention of activist investors, who aggressively acquired a controlling stake in the company. The subsequent proxy fight represented a fundamental clash of economic philosophies. On one side was the executive leadership, attempting a costly, desperate transition to a digital-first future. On the other was the activist shareholder bloc, demanding immediate cost containment, the restoration of traditional profit margins, and the resumption of dividend payouts. The timeline for survival had suddenly been compressed by the demands of the financial markets. The activist coalition ultimately succeeded, forcing the ouster of the forward-thinking executive team. The new leadership immediately dismantled the costly hybrid digital initiatives, redirecting capital back into the traditional retail storefronts to maximize short-term cash flow. This pivotal reversal sealed the corporation's fate. By prioritizing immediate shareholder returns over long-term structural adaptation, the board effectively surrendered the future of media distribution, doubling down on a business model that was already experiencing terminal decline. This strategic retreat was heavily compounded by a staggering burden of corporate debt. Years earlier, when the company was spun off from its parent media conglomerate, it was saddled with nearly $1 billion in debt obligations. Furthermore, to finance a special dividend payout demanded by shareholders, the company had taken on additional leverage. This massive debt load required constant, predictable cash flows just to service the interest payments, severely restricting the capital available for research, development, or strategic acquisitions. The mechanics of heavily leveraged corporate finance act as a strict governor on innovation. Debt covenants often dictate specific financial ratios that a company must maintain, legally binding management to conservative, cash-generating strategies. When a legacy business is highly leveraged, it fundamentally loses the agility required to survive a technological disruption. The obligation to creditors supersedes the necessity to innovate, trapping the organization in a rigid financial straitjacket exactly when maximum flexibility is required. While the legacy retailer was suffocating under debt and internal politics, the broader market was preparing for the dawn of the streaming wars. In 2007, the mail-based competitor officially launched its digital transmission platform, fundamentally altering the economics of content delivery. By sending data directly to the consumer, the marginal cost of distribution dropped to near zero. There were no physical discs to manufacture, no postage to pay, and no retail stores to staff. The economic efficiency of this new model was insurmountable for any physical retailer. The final catalyst for the corporate collapse arrived not from a technological competitor, but from the broader macroeconomic environment. The 2008 global financial crisis triggered a catastrophic freezing of the credit markets. Commercial lending ground to a halt, and highly leveraged companies suddenly found themselves unable to refinance their maturing debt obligations. For a corporation already struggling with declining revenues and massive fixed costs, the sudden evaporation of credit liquidity was a fatal blow. Simultaneously, the broader retail collapse began to accelerate. As consumer spending contracted during the recession, foot traffic in physical commercial centers plummeted. The 9,000 storefronts, once the ultimate competitive advantage, transformed into an unbearable liability. Long-term commercial leases could not be easily broken, meaning the company was legally obligated to pay rent on thousands of locations that were no longer generating sufficient revenue to cover their own operating expenses. The culmination of these systemic forces resulted in a formal bankruptcy filing in 2010. The vast empire of physical media was systematically liquidated, its assets sold off for a fraction of their former valuation. The contrast between the $50 million acquisition opportunity declined a decade earlier and the multi-billion-dollar destruction of shareholder value remains one of the most stark examples of structural rigidity in modern financial history. The physical infrastructure had been entirely outmaneuvered by the digital ether. The true lesson of this corporate demise extends far beyond a simple narrative of technological ignorance. Dominant companies like this do not ignore tech because they lack intelligence. They fail to adapt because their internal incentives, their debt structures, and their legacy capital allocations systemically forbid them from doing so. The very mechanisms that build a commanding market position often become the exact instruments of its destruction. When a business model relies on consumer friction and rigid physical assets, it is only a matter of time before a more efficient system inevitably bypasses it entirely.